Welcome to The Explainer. Today, we're going to jump in a time machine and go all the way back to 1996. We're looking at a single, kind of unassuming financial report from Berkshire Hathaway. But trust me, this document isn't just a bunch of numbers. It's the actual blueprint the company used to build a global empire. We're going to break down how the key decisions from this one quarter set the stage for decades of incredible dominance. Now, let's be clear. By the mid-90s, Berkshire Hathaway was already a total legend. Its track record was pretty much unmatched, and its business philosophy was like gospel on Wall Street. By all accounts, they were already winning the game, and winning it by a lot. But they were about to change the rules entirely. You see, 1996 was different. This wasn't just another winning year. No way. When you really dig into their own report, you can see this was the year Berkshire built a brand new kind of financial engine, one that was designed to launch the company into a completely different stratosphere. So where did it all start? It all kicked off with a single game-changing move in the insurance world. And this wasn't just another acquisition. This was like dropping a supercharged engine into an already powerful machine. Berkshire had owned about half of the insurance giant Geico for years. But just 2 days into 1996, they went all in. They bought the other half, taking full and complete control. This one decision, moving from just a major investor to the sole owner, would completely reshape their entire financial future. The impact was immediate and honestly, just staggering. Check this out. In the first 9 months of 1995, Berkshire's insurance business brought in about $580 million in premiums. Okay, not bad. But a year later, with Geico fully in the fold, that number exploded to nearly $3 billion. That is a more than five-fold increase in a single year. This wasn't just growth. This was a complete transformation of the business. Now, this deal created a really fascinating ripple effect on Berkshire's balance sheet. An obscure little line item called goodwill suddenly tripled. So what on earth is that? It sounds positive, right? But in the world of accounting, it has a very specific and very powerful meaning. Okay, let's break it down. Simply put, when you buy a company, you're not just paying for its buildings and computers, you're paying for its brand, its customer loyalty, its reputation, all that good stuff. Goodwill is just the fancy accounting term for the premium you pay for all those valuable, intangible things. And in Geico's case, that premium was absolutely enormous. Berkshire's goodwill jumped by $1.6 billion. This number right here is a direct reflection of just how much value Warren Buffett placed on Geico's brand and its market position. Way, way more than just the physical stuff on its books. So the GEICO deal is supercharging the insurance engine. But get this, at the exact same time, another part of the Berkshire machine, its massive investment portfolio, was having an absolutely blockbuster year of its own. One of the biggest market stories of the year was Disney's acquisition of Capital Cities/ABC, a true media mega merger. And as it just so happened, Berkshire was a major long-term shareholder in Capital Cities, which put them right in the middle of all the action. When the deal closed, Berkshire's investment was converted into a mix of cash and Disney stock, and the result was a staggering $2.2 billion pre-tax gain. Now, to put that in perspective for you, this single gain was nearly 4 times the company's entire net earnings from the same 9-month period just 1 year prior. It was huge. But here's where the story gets really interesting. In the report itself, Berkshire states this massive $2.2 billion event had, and I'm quoting here, a minimal impact on their shareholders' equity, which is their overall net worth. So how is that even possible? How can a multi-billion-dollar gain be considered minimal? Well, the answer comes down to a crucial accounting distinction. For years, as Berkshire's stock in Capital Cities grew in value, it was recorded as an unrealized gain, basically a paper profit that increased their net worth. When the Disney deal closed, that paper gain became a realized gain. It just moved from one column to another, from the balance sheet over to the earnings statement. So while the earnings for 1996 looked massive, their overall net worth hadn't really changed much because that value was already accounted for. So Berkshire has this supercharged insurance business and a huge pile of cash from its investments. But the real magic, the secret sauce that truly explains Berkshire's power, comes from a concept called insurance float. Just think about how an insurance company actually works. They collect premiums from thousands and thousands of customers, but they don't have to pay all of that money out in claims at the same time. So what happens to that giant pool of cash while it's just sitting there? That pool of cash is called float. It's the money collected from premiums that an insurer holds onto before it has to pay out any claims. And here's the crucial part. They can invest that money for their own profit. It's essentially a massive interest-free loan from their policyholders. It's an incredible advantage. By the end of the third quarter of 1996, Berkshire's float had swelled to a staggering $6.9 billion. Let that sink in for a second. That's nearly $7 billion of other people's money that Warren Buffett could use as the fuel for his investment engine. And this is where we see the full impact of that Geico deal. Of that nearly $7 billion in float, over a third of it, a cool $2.5 billion, came directly from the Geico acquisition. So taking full ownership didn't just boost revenue, it massively expanded this strategic financial secret weapon. Okay, so let's recap. You've supercharged your engine, your fuel tank is overflowing, what's the next move? Well, you drop the blueprint for an even bigger empire, and that's exactly what Berkshire did next. Berkshire faced a pretty unique challenge, though. Its Class A stock was famously expensive, which made it kind of impractical for doing smaller acquisitions or for raising capital in flexible amounts. To fund their next big wave of growth, they needed a new tool in the toolbox. The solution was brilliant. In 1996, they created the now famous Class B shares, often called baby Berkshires. This opened the door for smaller investors, sure, but more importantly, it gave Berkshire a new, flexible tool to raise money. And that very first offering brought in over $500 million in fresh capital. So when you put all the pieces together, the 199 master plan becomes crystal clear. Step 1, acquire Geico to supercharge the insurance and float engine. Step 2, create Class B stock to raise flexible new capital. And Step 3, put that capital to work immediately. Right after this quarter ended, they announced their next major acquisition, a $1.5 billion deal for Flight Safety International. Boom, boom, boom. You see, this Q3 1996 report is so much more than just a snapshot of a successful company. It's a foundational document, a blueprint, showing a company deliberately re-engineering itself for global scale. And it leaves us with one powerful question. With all these pieces so perfectly in place, what would Berkshire build next? Well, the following 2 decades would provide a pretty remarkable answer.